the sun is definitely shining on the solar sector. Seems like everywhere you look. But which companies are actually lighting up their balance sheets? Welcome to the deep dive.
Exactly. Today we're cutting through some of that green energy hype, getting granular.
Yeah, we're analyzing the 3 largest U.S.-based solar companies by market cap.
Right. Our mission today is really to give you a comprehensive journalistic analysis. We're diving deep into, well, 4 critical areas: fundamentals, valuation, technicals, and the latest news flow.
And the companies are First Solar, FSLR, Nextracker, NXT, and Sunrun, RUN.
That's them. And just so everyone's on the same page, the performance data we're using is based on the close of trade, October 24th, 2025.
Got it.
And, it's really crucial to remember as we unpack all this data, this discussion is purely informational, educational. We're analyzing public data from our sources. It should absolutely not be taken as investment advice.
Absolutely. That distinction is key. Because, look, these aren't 3 peas in a pod, right? They're really different business models.
Completely different.
You've got the manufacturer, this sort of hardware disruptor, and then the consumer installer. Yeah. Their financials. Couldn't be more segmented.
And that's what makes this deep dive, I think, so fascinating.
Okay, let's kick things off with FSLR, First Solar. The large cap leader, market cap around what, $25.89 billion?
Yep, that's the ballpark.
They're the industrial backbone, really focusing on manufacturing the panels themselves, specifically their proprietary cadmium telluride or CDT solar modules. So when we look at their fundamentals, what kind of character are we beating here?
Okay, think of FSLR as maybe the blue chip of the solar sector. It's really the definition of financial stability in what can be a pretty volatile space.
Okay.
They're reporting positive income, $1.26 billion, and an impressive profit margin, nearly 29%.
But the number that really jumps out at me, especially for a manufacturer, is that massive gross margin, almost 43%. How are they pulling that off in a sector where, commodity costs usually squeeze every single point?
That's the key, right? That's the core competitive advantage we really need to flag here. Unlike most global module makers who rely on silicon, which is, as you know, a notoriously volatile commodity, First Solar uses CDT.
Their own tech.
Exactly, their proprietary technology. It shields them significantly from those big commodity price swings, and that allows them to maintain those, frankly, industry-leading margins and run a very predictable operation.
Okay, that makes sense. That explains the margins. And their debt picture looks equally conservative?
Absolutely. I mean, their balance sheet is rock solid. You've got a low debt-to-equity ratio, just 0.12, long-term debt, even lower, 0.05.
Wow.
And their liquidity metrics, things like the quick ratio at 1.41, the current ratio 1.9, they just confirm that FSLR is running a tight ship. Highly profitable, cash efficient, and well buffered.
All right, let's look at valuation then. The traditional PE ratio seems moderate, 20.64. But that forward PE, it suggests massive optimism, doesn't it?
Yeah, this is where it gets really interesting. The market is clearly anticipating spectacular earnings growth. That pushes the forward PE way down to 10.52.
Okay.
And even better, look at the PEG ratio. It compares that PE to the expected growth rate. It's highly attractive at 0.63.
And under 1 is usually considered good, right?
Generally, yeah. For those tracking, anything under 1 often gets a green flag. It suggests the growth trajectory, which, by the way, is anticipated to be over 51% in EPS next year, might actually be cheaper right now than the valuation reflects.
Okay, turning to the price action. FSLR closed at $241.41. What are the technicals telling us about its momentum?
Well, it's performing exceptionally well. The stock is currently only, 2.67% away from its 52-week high. That's very close.
Very strong.
And the long-term trend is undeniable. The current price is trading a staggering 41.19% above its 200-day simple moving average. That's a strong uptrend.
And near-term signals, like the RSI.
Yeah, the 14-day relative strength index, the RSI, it's sitting at 62.47.
Yeah.
So strong momentum, but it hasn't quite crossed into that typical overbought danger zone, usually pegged around 70.
Gotcha. And the news flow seems to back this up. They beat earnings, raised their sales outlook.
Correct. Very positive recently.
But I have to ask about one potential red flag I saw mentioned. Consistent insider selling activity. Even the CEO. Isn't that usually seen as a massive vote of no confidence, especially for a company this tight?
That's a critical point and something you definitely need to address when you see it. While consistent insider selling always warrants attention, the context here matters. A lot.
Okay.
In this case, our sources indicate this activity is often tied to pre-scheduled executive option exercises, part of their compensation structure. It's not necessarily opportunistic dumping because they know something bad is coming.
Ah, okay. So planned sales mostly.
It seems that way, based on the sources. It's a crucial distinction when you're trying to assess management conviction. And look, we also see very high institutional ownership, over 105%, which indicates strong professional conviction in the FSLR story.
Okay, that context helps. Now let's do some fun paper money math. If someone hypothetically put $5,000 into FSLR at that $241.41 price, how would they have fared over, say, the last 6 months?
All right, paper money time. A $5,000 commitment would get you approximately 20 shares. Based on its trailing performance over the half year, which was a spectacular 70.17% gain, that investment would have generated an estimated paper profit of about $3,508.50.
Nice. So the total estimated value would be around $8,508.50. It really shows that, stability and profitability can still deliver some exceptional velocity.
Okay, so we've seen the stable module manufacturer. Now let's shift focus to maximizing output. Let's pivot to Nextracker, ticker NXT.
Right, the tracker specialist. This company doesn't make the panels. They make the integrated solar tracker and software solutions, the things that make sure those panels are always tilted perfectly towards the sun.
Getting every last drop of sunlight.
Exactly. It's a more asset-light model, it seems, and that's driven a market cap of $14.54 billion, even though they only IPO'd back in February 2023. Pretty recent.
Yeah, NXT is definitely the high-growth disruptor in this group. Their financial profile, it's all about exceptional growth and efficiency. Pretty typical of an asset-light, IP-focused model.
Okay, give me some numbers.
Sales quarter-over-quarter growth is exceptional, 42.43%, and their 5-year sales CAGR, over 20%. Consistent, strong growth.
And their efficiency ratios look phenomenal, too. I'm seeing a high ROE, 35.44%, ROIC, 31.42%. Why are these so much stronger than even FSLR, which is also highly profitable?
Good question. It's because they aren't tied down by those massive capital expenditures, right? Building factories, heavy manufacturing, that costs a fortune.
Right.
NXT's focus is on the mechanics and the software, you could say the brains of the solar farm operation. That allows them to generate really high returns on their invested capital. And get this, with virtually no long-term debt. Debt to equity is just 0.01.
Almost zero debt. Impressive. They're expanding fast but efficiently.
That's the story.
Okay, so given that growth, it makes sense the market's applying a bit of a premium. Their PE is slightly higher than FSLR's at 25.51.
Exactly. That growth premium is definitely baked in. Their PEG ratio reflects that too. It's higher at 2.81. That suggests the current price might already be heavily discounting that massive future growth potential.
But people are paying that premium because, well, look at the stock's velocity.
Well, yeah. Let's unpack this technical picture. NXT closed at $98.28, and the performance metrics are just, well, eye-watering.
They really are. Explosive.
NXT has a year-to-date performance of 169.04%, and the full-year performance, over 206%.
It's just incredible.
And what's really fascinating here is that the stock is currently trading 4.66% above its 52-week high. It's literally forging new highs as we speak, firmly in price discovery mode.
But the technical screens are flashing a bit of a warning sign here too, right? That RSI you mentioned earlier?
Correct. The 14-day RSI is high, 73.48. Now, while that indicates massive recent demand, it does suggest the stock is entering overbought territory. That increases the risk of maybe a near-term pullback or consolidation.
Okay, something to watch.
Definitely. And furthermore, its high beta, 2.22, means this stock moves. It moves hard and fast with the overall market.
So more volatile than FSLR?
Much more. Practically speaking, if the S&P 500 moves 1%, NXT tends to move over 2.2% in the same direction. That amplifies both your gains and potentially your losses. Analysts seem to see this. They're leaning towards a buy-hold mix, target price around $100.25.
And the news flow is equally aggressive. Beating earnings, raising outlook. I saw mentions of strategic acquisitions, expanded into the Middle East, even linking their tech to AI energy growth.
Yeah, that AI energy tailwind is a powerful narrative right now. Huge power demands expected. And yes, positive news on earnings, outlook, strategy, acquiring Origami Solar for low-carbon steel frames, expanding in Saudi Arabia. Plus, like FSLR, we see nearly 100% institutional ownership. The big players believe in this expansion story.
All right, let's run the hypothetical for NXT. What did that incredible price action mean for paper gains if we'd committed $5,000?
Okay, $5,000 invested at $98.28 share gets you roughly 50 shares, based on their massive performance half-year gain of 125.15%. That $5,000 investment would have generated an estimated paper profit of, wait for it, $6,257.50.
Wow, more than double the initial stake in 6 months, hypothetically.
Exactly. Total estimated value would soar to $11,257.50. It just demonstrates that extraordinary financial velocity you can get from these asset-light, high-growth models.
Okay, finally we turn to, well, the volatility king of the group, Sunrun, ticker RUN.
Definitely the wild card.
This is the largest installer of home solar systems. Their focus is residential sales and leasing. Market cap around $4.81 billion. And this model, it just screams massive capital needed up front, doesn't it?
That distinction is absolutely crucial. Sunrun's business model, it's fundamentally closer to maybe a consumer finance company or even a mortgage company than a traditional manufacturer like FSLR.
Okay, interesting comparison.
And this is reflected directly in a very high-risk, high-reward financial profile. It's defined by aggressive growth, yes, but also really high leverage.
Yeah. I have to stop you on this fundamental data point.
Yeah.
Because compared to the profitability we saw with FSLR and even NXT, Sunrun has negative ETS, negative income of negative $2.57 billion, and a profoundly negative profit margin of negative 120.53%.
It's stark, isn't it?
How is this even sustainable? What are investors actually buying here?
Okay, the sustainability question is tied directly to their debt structure. That massive debt load you noted, a debt-to-equity ratio of 4.83, is driven by financing all those residential installations and long-term leases.
The upfront cost.
Exactly. They take on huge debt now to secure decades of revenue from those residential customer contracts. But that approach leads to those deeply negative margins right now and a severely negative ROE of negative 61.90%. It makes them highly sensitive to interest rate environments.
So investors are buying future promises.
Essentially, yes. They're buying the future revenue stream from millions of contracted residential customers, betting that eventually it turns profitable on the bottom line.
Okay. Valuation must be tricky then, with negative earnings.
Indeed. The standard PE is NA, not applicable, but the forward PE is a high 28.89.
So still pricing in future profits.
Clearly. Investors are betting on that future where those contracted revenues finally translate into actual profits. This is despite the fact that EPS next year is actually expected to drop significantly by over 46%.
Wow, quite the gamble.
It's pure volatility baked into the model. You see massive quarter-over-quarter EPS growth recently, nearly 97%, but then followed by heavy future uncertainty. It whipsaws.
Speaking of volatility, let's look at the price action for RON. Close at $20.85. The technical picture here is just a breathtaking recovery, right?
It is the ultimate comeback kid story in this group. The stock has posted a massive 287.55% gain from its 52-week low of just $5.38.
Incredible bounce.
And its performance over the last half year is equally incredible, up 182.14%.
So this stock moves even faster than NXT.
Confirmed by the data, it has the highest beta of the group, 2.33, meaning the stock dramatically amplifies market movements even more than NXT.
Okay.
Also, look at the 200-day moving average. The current price is a whopping 93.67% above it. That just illustrates the sheer sharpness of that recent rally. The price is soaring far above its long-term average.
I see a really high short float number here,
Yeah.
26.09%.
Yes, that's significant. It indicates a massive number of investors are actively betting against the stock. That high short interest is actually the fuel for the kind of explosive short squeeze rallies we've seen recently with RN. When good news hits, shorts have to cover, driving the price up even faster.
Makes sense. And the news flow here seems incredibly sensitive to external factors, politics, regulations.
Very sensitive, extremely. We saw massive surges mentioned following positive clarity from the IRS on tax policies, and drops linked to political comments. But there's also positive news on the strategic side, like their first residential vehicle-to-grid deployment using Ford F-150 Lightning trucks. That's pretty cool tech.
Yeah, V2G is interesting. What about insiders and institutions?
Similar pattern to the others, consistent insider selling noted, often tied to scheduled exercises. And again, high institutional interest ownership above 103%. Remember, for the listener, when you see institutional ownership over 100%, it often suggests shares are being counted multiple times due to shorting activity or maybe derivatives. It just points to extreme professional interest and positioning, both long and short.
Got it. Okay, final paper money math for RUN. given its spectacular run-up. What's the hypothetical potential for a $5,000 commitment?
All right, $5,000 at $20.85 per share would purchase approximately 239 shares. Based on its trailing half-year performance, that staggering 182.14% gain, that position would have yielded an estimated paper profit of $9,107,
Almost tripled the initial investment.
making the total estimated value soar to $14,107. It just starkly illustrates that high-risk, high-reward nature that seems unique to this residential installation model within the solar space. Hashtag tag outro.
Wow. What an illuminating contrast between these three. We've analyzed FSLR, the stable, profitable manufacturing powerhouse, very low debt, then NXT, the high-growth asset-light tracker specialist, setting new highs. And finally, RUN, the highly leveraged residential installer that, well, delivered the biggest recent stock gains despite those deeply negative fundamentals.
Yeah, and if we try to connect this to the bigger picture, you see all three companies, despite these massive differences in financial health, are riding this powerful sector-wide wave of upward momentum right now.
Seems like a rising tide lifting all boats, maybe.
To some extent. This enthusiasm seems driven by policy tailwinds, maybe some regulatory clarity, and certainly recent strong earnings performance, particularly from, the more capital-efficient parts of the supply chain like FSLR and NXT showed.
But the sources revealed that common thread, didn't they?
Yeah.
Massive institutional ownership in all three. And NXT and RUN have those exceptionally high betas. These look like professional-grade momentum plays.
That's a good way to put it. And this raises, I think, an important question for you, the listener, to consider. Given this high institutional concentration and the significant market sensitivity of these positions, especially for the highly leveraged and policy-sensitive RUN and the potentially overbought NXT, how quickly might sentiment shift? Or maybe more realistically, how quickly could political or regulatory policy shifts impact these stocks?
Yeah, good question. Which company, defined by either that long-term stability like FSLR or the explosive velocity like NXT and RN, is maybe best positioned to weather the inevitable next storm? Because there's always another storm, right?
Always. It really comes down to a fundamental question of risk tolerance versus reward potential in the solar sector today. Lots to think about.
That's certainly something to mull over as you process these numbers and these different models. Thank you for joining us for this deep dive into the U.S. solar sector.